Hello, everyone, and once again, welcome to the Smart Investor Podcast. Okay, it's bright and early Monday morning, and we have some very interesting market action ahead of us. So, in today's episode, we are going to speak about the technical picture of what's happening in the markets. We're going to look at S&P 500, the Dow, the Nasdaq, the FTSE. We're going to also look at the German DAX. And we're going to look at gold, what's happening in gold and silver, the dollar, and we're going to briefly examine Apple, Netflix, and Nike. So we have a lot of markets we're going to be really delving into. And the main story today is the sell-off in the stock market. Earlier last week, I said that if we do not break above the 2000, let me get the exact level. If we do not break above the 2123 level in the S&P 500, you could see a massive sell-off in stocks, and that is exactly what is happening. Remember, traders and investors react to price action and what's happening in the markets, and that's why sometimes we see when these levels are not overcome, then traders automatically sell positions. Okay, so we're going to see what is next from here in the S&P 500 and the major stock indices. If you would like to look at a visual representation of this podcast, you can go to smartinvestorcentral.com /market update, and you will see the charts that we're speaking about, and you can get a bigger picture of what is happening visually. Okay, so the first market we're going to look at is S&P 500, and the S&P 500 is currently in what technicians call a channel, and the boundaries are at roughly 2040 and up at the 2130. So to be just round it off, it's about between 2140 and 2040. So 100-point range. That's a channel in the S&P 500, and we have been stuck within this 100-point range ever since February of 2015. So ever since February, we have just really been meandering in a channel, and when we are meandering in a channel and the channel has lasted this long, that means that the channel is fairly significant to technicians. And if we see the market break below these levels or above the channel, that would issue in even more buying or more selling in the markets here. So that's why this channel is very important. Okay, so we're approaching now the bottom of the channel. We're at 2069 as of this recording, and we could get down to the 2040 level, and that's where we should see some support. If we see the market break below the 2040 level, that will be fairly bearish for the stock market, and the next area of defense or support is the 1980 level. And if 1980 is breached, then that will issue in even a larger downtrend in the stock market. So the S&P 500 is fairly vulnerable right now to a pullback. Remember, the market hasn't really seen a major pullback since October of 2014, where the market declined from a high of 2019 down to 1820. So that was the last time we had a major decline, as you can see on the charts. So there could be a correction coming in the S&P 500. So the levels to look out for again is 1980 and 2040. If 2040 is breached, then it brings in 1980. If 1980 is breached, then that would be fairly bearish for the markets, and we could be in for a deeper pullback. Looking at the Dow Jones Industrial Average, Dow Jones Industrial Average, the chart pattern is not as crisp or clean because we are currently below the 17,600 area, which is critical support in the Dow, and we're trading below it, and we're at 17,444. The next area of support is down at 17,000, and if we breach 17,000, then that will definitely signal a much larger pullback in the Dow Jones Industrial Average. So the markets are looking fairly toppish at this moment, and we just have to be on the defensive when the market is selling off like this. But I would pay greater attention to S&P 500 because it's a broader market. It's 500 stocks, and you can it tends to be a better gauge of the overall market picture rather than the Dow. Taking a look at the Nasdaq, we see that the market is selling off, just like the other stock indices, but it's finding support in this 4,500 region, and that is fairly positive for the Nasdaq stock index. So it's the chart of the Nasdaq does not look as bad as S&P 500 or the Dow Jones Industrial Average, which could be fairly positive for the broader market. Okay, so we're definitely in a minor pullback with stocks, and what is a minor pullback can turn into a major pullback if the levels I spoke about earlier are breached. Looking overseas in the German DAX, we see that the market is pulling back slightly. The chart is not as ugly as S&P 500, which again is fairly positive for stocks on a whole, because we could see some buyers come into the German DAX, which may help to support the US market also. Taking a look at the FTSE has not really looked good in terms of the charts, and this is the most worrisome chart because we topped out way back in April, and we have a double top scenario on the FTSE. We have a top that was made in 1998, and now we have another top that was completed in 2015. And for those of you who are watching this analysis, you see the top that was made in 1999, and you also see the top that was made in 2015. And if this is confirmed, this is what we'll call a double top, which is fairly bearish for the market. A break below the 6,000 level for the FTSE would I believe trigger even more selling for the UK stock. So that's definitely something to keep an eye out on. The FTSE is not looking good technically. Okay, the US dollar this morning is trading to the downside. We had resistance up at the 9,800 level, and the market failed to overcome that 9,800 level and is pulling back. And the US dollar is down just about against all the major currency pairs this morning. The market is now trading at 96.42 on the US dollar index. Support is down at 95.45, and resistance is up at 9,800 for the US dollar index. The dollar, as some of you may know, has had a very good run over the last couple of months, and what we could be seeing is that this will be the start of a major correction in the market. If the market does not overcome this 9,800 level, we could see a greater pullback, and a close below 9,200, or actually more precise 93.13, would be fairly bearish for the US dollar. And remember, the reason why we look at chart patterns and what's happening in the markets is because the charts are actually telling us what the smart money is up to. They're telling us which side of the market the smart money is on. So we're not really depending on what the media is saying or what the fundamentals are looking out for or looking at. And I believe that is definitely the best way to gauge what's happening in the markets and not staring at CNBC. And I believe looking at CNBC and a lot of these business channels ultimately will allow you to lose money in the markets because they are way behind what is going on in the markets. And it's listening to market analysis like this and other up to the minute market analysis, you can gauge what is happening in the markets, and you can even react before the general public reacts. And that's how you are able to stay ahead of current trends in the markets and stay ahead or stay ahead of other investors, really, and ultimately make more money. Okay, so taking a look at the oil market, we see that oil was pulling back last week and continues to decline, which is very good for consumers here. And because oil is going down, because gold is going down, because the US dollar is generally going up, folks are saying we're in a deflationary environment. And how would you how would you invest in a deflationary environment as opposed to an inflationary environment? I know the common theme over the last 4 years or so was waiting on inflation, but taking a look at the gold market now, we see that inflation trade has not done very well over the last couple of years. For example, we see that gold between 2011 and 2015, gold is down almost 30% from the high up at 1900, and it's down over $900 since the high. And that's why it's important to be on the correct side of the market and not pay attention to advertisements or theories out there. And because, as you can see, the market is in a series of lower highs and lower lows. Lower highs, lower lows. What does lower highs and lower lows mean on a chart? Lower highs and lower lows means that the market is in a downtrend. And we do not generally invest in markets on the long side on markets that are in downtrends. We tend to, when markets are in a downtrend, it's best to be on the short side of the market. And you could be on the short side of the market by actually investing directly in the metal short or options. You buy puts on the metal or buy the gold ETF that takes advantage of the short side. So there are various avenues you could use to take advantage of the short side. And the reason that we knew that gold was going down is because it is actually trending down on the charts. And instead of essentially paying attention to what the news media is saying, paying attention to what advertisers are saying, you could look on the markets yourself and see that the market is clearly in a downtrend. And even if you do not want to invest on the short side, you will know to stay out of a market like this and wait until the setup is perfect for the long side of this market. And I've heard quite a number of stories of folks who have lost a lot of money in the gold market in recent times. Okay, so that's why it's good to pay attention to what's happening in the markets. If you would like a free, and that's why we're here to educate investors, if you would like a free stock, really market course, how to determine trends, what you should do before you buy and sell a particular stock or a particular asset, you can go to smartinvestorcentral.com and get the free DVD that explains all of this in great detail. I can assure you it will do your portfolio wonders. So smartinvestorcentral.com, and get the free course. It's absolutely free, and you can see exactly how to interpret where our market is going. The course is not going to turn you into the next whiz trader, but it can definitely show you what exactly. For example, if your financial advisor recommends that you get into gold and you see a chart like this, you will know that it is not time to be in gold because the gold is in a strong downtrend. So we'll give you specific ways to read these things. And there will be a time to get into gold because the market cannot go down forever. And then we'll give you tools to pinpoint exactly when the market will turn around and what to look for in a turnaround situation. Okay, so that's smartinvestorcentral.com, and you'll see on the right hand side where you can get the free course. Okay, so how low will gold go? And that is the question. Well, we just made a new low over last month. Let me look on a monthly chart here. We have made a new low, and we're currently trading at 10,099, and we broke out of a consolidation pattern in the gold market. And after a breakout of a consolidation, we normally get a slight recovery, and then the market could head down further. So taking a look, we could see $1,000 gold or $900 gold in the next couple of months. What would negate that is if the market was to somehow trade above the 1250 level. If we see the market trade above 1250 and then ultimately above 1300, then that would indicate to me that gold is on a way of recovery, and we could see higher highs. But until those levels are breached, then I would remain on the short side of this market. Okay, looking over at some individual stocks, and I'm just giving you the technical picture of certain stocks. Taking a look at Apple, we saw that Apple made a new high. The market made a new high earlier in the year and was looking fairly positive. But we have a situation here that the market made a new high in February. We see the high here in February. That's peak 1. We see another high that was made in April. That's peak 2. And we see another high that was made in July. That's peak 3. So this could be setting up for what they call a triple top in Apple. And a close below 120 would definitely make me very cautious in Apple, and could issue a larger sell-off in the stock of Apple. So that's a key area to look out for. In Apple. And if we do breach 105, which is definitely $20 over, about $20 below this level, that will be very bearish for Apple. So those are the levels to look out for. So a potential triple top on this market, and a close below 105 would be very bearish. Okay, taking a look at Netflix. The chart of Netflix made a fairly substantial move to the upside this year and has done very well. But remember, when we're investing, yes, it's good to know when to get in the market, but it's also important to know when to get out and when to take your profits. And I can say the chart of Netflix is still looking fairly positive. And if I was in this stock, I would be holding this stock because technically the market is still in a strong uptrend. Yes, we have had a slight pullback from the high that was made of 117. We're currently at 108. But that seems to be a minor pullback as of now. A close below 90 would give me a lot of pause, and I would probably think of taking profits if the market closes below 90. Okay, taking a look at Nike. Stock of Nike. technically, Nike has also done very well, and the pullback in Nike so far is very minor. The high that was made is at 114.70, and the pullback so far has taken it to 112.38. So this, in my mind, is still a hold, and this is a stock that I will be holding on to. There's no need to be selling Nike just yet. And remember, if you want to know how to greater understand when to buy and when to sell the stock, you can go smartinvestorcentral.com and go get that free course that will definitely shed greater light on when to buy and when to sell a particular stock. Okay, so let me just peek at S&P 500. Again, the market is recovering, and this SPY ETF, the market is recovering slightly, and take a note of those levels that we spoke about earlier to see if we are going to get a further pullback in the markets. Okay, thank you very much for listening to this edition of the podcast. And remember, the charts tell the story and not the media. The charts are the ones who tell where the markets are going and what the market is doing. And a proper reading of the charts will keep you on the correct side of the market. So this is Beyond. Thank you very much and have a very good day.